All right. Yeah, thanks for signing on tonight. My name is Jason Powers. I am what we call an authorized IBC practitioner. I'm a real estate investor. I'm a business owner, and I kind of eat, breathe, and sleep teaching people about the infinite banking concept. I got into it myself years ago. I was doing real estate investing as well, and once I got into this as a career, I've been wholly convinced. I'm like, every real estate investor needs to know about it. I think everybody needs to know about it. But more importantly, my focus has really been the real estate investing world. I've partnered with the National Real Estate Investor Association, so I get to travel around and teach different RIAs around the country about infinite banking as well. Anyway, we're going to dive in tonight, a crash course on infinite banking. Is it for you? And we'll go from there. Usual disclaimer, this is not tax or legal advice. We will give you the best advice we know. However, seek your own counsel for some of that as well. Your AZREIA team for Unbridled Wealth is myself, Jack Carlson, who's down in Tucson area, and Olivia McGraw, who's up here in Denver with myself. We are going to talk about the infinite banking concept. There's a book here on the screen called Becoming Your Own Banker. It is a short 92-page book. I'm going to give you a link at the end if you want to grab a copy of it. Feel free. And it's a good read. It's kind of the source of infinite banking and where it came from. And so I'm going to give you a crash course if you're a reader. Grab that book, at the end. And I'm not here to sell books, but it's just a great resource. Grab that book and check it out for more details on infinite banking and the concept behind it. So diving in, infinite banking, it's just some financial hack. It is about taking control of the banking function in your life. I always ask people, what would life be like if we never had to pay interest to an outside bank again? How much would that change our lives? What would it be like if our kids never had to go to a bank again, the next generation behind us? They never had to go to an outside bank again. They could finance their own deals in real estate. They could borrow from themselves or from the private family bank for a car, for a mortgage, and so forth. And so that's what we're going to kind of talk about tonight. The infinite banking concept is the best place to warehouse your wealth. That has guarantees. It's got safety, ready access to your money, and allows you to take over that banking function in your life. So that's what it's about. How do we control that? Because what are we controlled by in our society today? We're controlled by debt. We're controlled by the banks. And I don't mean that in a conspiracy kind of way, but I mean, we finance everything we do in our lives. We finance with credit cards. We finance our cars, our houses. We finance our real estate deals, right? And colleges and even retirement. We shove our money into these tax deferred qualified accounts that we cannot touch until later, or we're penalized for touching it, or we have restrictions if we're going to use it now. And this just gives you an alternate vehicle to do all of the above. So the vehicle through which we show people how to do this is properly structured, dividend-paying whole life insurance from a mutual carrier. That's a mouthful. I always joke because I say that 10 times fast. So I'm wordy about it. Properly structured, dividend-paying whole life from a mutual carrier. I am wordy about it because it is particular. It is not, as we say, your grandparents' old life insurance policy. It is not the whole life insurance policy that certain financial gurus today rail against. They say buy term, invest the difference. It is structured differently. Okay, so we say properly structured. There's a specific way to structure those today so that you have maximum cash value access early on, not somewhere down the road. Okay, dividend paying from a mutual carrier. The reason I say that is there are two types of insurance carriers. There are stock companies, its interests are for the stockholders, and there are mutual carriers. As a policyholder, you're effectively one of the owners of the company, thus entitled to the profits, which come in the form of dividends. So that's why I say dividend paying from a mutual carrier. And tonight I'm talking about strictly whole life insurance. If you've heard about other types of life insurance, certainly term, we're not talking about IULs, VULs. We're not talking about those tonight either. We're talking strictly about whole life insurance. Okay. Give me a thumbs up or in the chat or something if you can. I just want to make sure everybody can see my screen. It says the vehicle I want to make sure you guys can hear me okay too. Any thumbs up or chat or something?
I can see and hear.
Good to go, Megan?
Yep.
Okay. All right. So we have this common knowledge that we're taught. We're taught this common knowledge, financial knowledge, that is. And then there's this whole slew of uncommon knowledge that we're not taught in traditional financial circles. And that's what the further into this I get in my financial walk, and the more I hear it's out there, yeah, kind of the more frustrated I get, because I'm like, people need to know about this stuff. They need to know that they have other options. There's a place for traditional financial models, traditional financial approaches, but we don't know what we don't know, and so we don't take advantage of potential other opportunities, right? So um, I'm going to go over kind of some of the aspects of utilizing infinite banking. As we talk about infinite banking with people, I encourage them to not get hung up on the dollar amounts. Don't get hung up on, oh, I could never do something like this because I don't have such and such extra dollars. I don't have X amount of extra dollars. It's not always about how much extra money you have. Often, more often than not, it's about changing the flow of your existing money. And by changing the flow of your existing money, you create these financial opportunities. And I'll unpack that here in a little bit. One of the single greatest benefits of utilizing this is the fact that the cash value inside of your policies will grow uninterrupted through your entire life, whether or not you're utilizing the cash value. What do I mean by that? I mean, when you borrow against the cash value, the whole amount will still be inside your policy growing as if it never left. So it has a guaranteed gross growth rate inside your policy, and they're saying it's definitely going to grow by X amount, not an investment product, okay, but it'll grow by X amount. And throughout your whole life, it's going to compound uninterrupted throughout your entire life. And then you can borrow against it, against that amount. But it's not going to interrupt the growth of the policy. And there just is not another vehicle out there like that. If you have a savings account that's growing at 2%, and you pull some money out, it's only growing at 2% on what you left in there. If you've got an investment account that you're borrowing against, borrowing from to do an investment or whatever you left in that account is what it's growing at, not what used to be in that account. Does that make sense? Okay, so another feature just kind of takes advantage of the lost opportunity cost that we run into if we're dumping cash, if we're paying cash for everything, and we can lose opportunity in other places. There is an income tax-free growth component of these policies. Throughout your life, this cash value will exceed your outlay. In other words, what you've been putting into the policies, your cash value over time will exceed your outlay. And I'll show you an example here in a little bit that gain will be substantial throughout your life. Especially the longer you have to compound it, the greater the spread will be. And you can utilize that even into retirement. So you can use it now throughout your life, borrow against it, be your own bank, finance your own deals. You can be your own car loan if you want. You can quit using your credit cards, or use the credit cards and get the points, and then borrow against your policy and pay it off. You can build up enough to start doing down payments on properties, start private money lending, whatever you want in real estate, buying properties outright. And then when you're ready to retire, you've built up enough cash value, you can start supplementing your retirement with it, income tax free. It is safe from investment booms and busts. This is not an investment product. This is an asset. If you look on a balance sheet for companies who own cash value life insurance, it is an asset on their reports. Loans, when you borrow against policies, loans are not tied to your credit. No one sees it except the insurance carrier, you, and probably me, because you told me you needed to take a loan and I got it going for you. So loans are not tied to your credit. Even, for those applying for a FAFSA or parents, we don't have to report that for the kids if we're applying for FAFSA or something like that. That's a nice little thing. Unstructured loans. When you borrow against the policy, the loans are unstructured, meaning you get to dictate the loan terms. You can borrow, if you have 10,000 built up in your policy and you say, okay, I'm going to borrow 10,000. You can take a day to pay it back, a month to pay it back, a year, 10 years, whatever you want. And you can dictate how much you're going to pay over that time. You can pay irregularly, you can pay regularly, however you want to set it up. So you control the banking function at that point. Multitasking dollar. Megan, you got a question real quick?
Yeah. Just now when you mentioned the FAFSA, does the amount of your cash value affect it? Or
No,
is
it's
it
not
just
reported. You don't have to report it.
the life insurance policy at all?
Uh-uh. Nope. I did, like when I did it with my stepdaughter, I didn't have to report it at all.
Interesting. Okay.
Yep.
Thank you.
Multitasking dollar. So your dollar, your cash value can be doing multiple things at once. It's growing, one, inside the policy. Two, it is growing on whatever you borrow and you use it to make money. So real estate investing. I'm going to borrow against the policy, and that money's going to make money, but my money's sitting here inside the policy also growing. So it's doing two things at once. Or if you're borrowing against it, and it'll save you money. Save you money or make you money. That's the goal. Don't buy a pack of bubble gum with it. You know, it's about saving money and making money. And it's a long play. Okay. Now, of course, it's life insurance. So we have the generational wealth transfer. Oh, well, I don't have a family. Well, if you have something you want to leave a legacy to, no problem. You know, we have people all the time, single, no family. They have no persons they want to leave it to, so they'll leave it to nonprofits that they really care about. You know, we've got a great client that is funding a library. He's the third generation funding this library. So it's just neat. He just wants to keep carrying it forward. Okay, why whole life insurance and who cares? Banks are not ignorant with money. They're pretty smart with their money. If you look at their balance sheets, which you can find online, they carry billions of dollars in cash value whole life insurance. Billions with a B. That is, they have insured their executives, all these key man policies they have, their executives, a lot of employees. They carry billions of dollars in cash value whole life insurance. They actually, some of these banks own more in cash value than they do in real estate, which is fascinating. And you start going, well, why is that? Well, one of the major reasons is they understand the uninterrupted compounding component and the benefit of that over the long run of someone's life. Two, as a policy owner, if you own the policy, you can utilize the cash value while you're the policy owner. So if you own policies on your children, for example, you can control the cash value now and build it up for them. At some point, you'll hand over ownership to your children, most likely, and then they can carry it forward. Banks, if they own the policies on their employees, they control the cash value. How much more money can they make by loaning out even more money? Okay. Fortune 500 companies, these companies understand it. They used it, utilize it. It's kind of fun as you start digging around historically and seeing who's used it. You know, fun story about Walt Disney could not get enough of a loan to finish building a theme park based on a mouse out in California. And so he actually borrowed cash value from a life insurance policy he had and finished funding Disneyland. If you look a little bit further, Ray Kroc, when he bought out the McDonald brothers, he had a couple of cash value whole life insurance policies. He used one to pay some key employees early on. He used another actually to start a marketing campaign on his newest, latest, and greatest mascot. Any guesses who that was? Mr. Ronald McDonald. You know, and so it's just kind of fun as you dig around and see, you know, how has it been used in the past. Certain dignitaries knew about it. They know about it. They use it. Interesting article came out on President Biden when he had to disclose his finances back when he was running under Obama. talked about how he owns 0 investment products, but 6 whole life policies. And I thought that was pretty interesting because I'm like, the guy's not broke. And what's he doing? Why does he own no investment products and 6 whole life policies? What is he up to? So it has its benefits. People are using it. It is not common knowledge. It is in the uncommon knowledge sector of financial education. And why is that? It is not, let me make a point, it is not just for the wealthy either. It can be for everybody. Nearly everybody can do it at some level. So like tonight, as we unpack some numbers, don't get caught up on the number of zeros on the policy. Understand the principles and the growth and why it's growing and how it's growing. We'll come up with a customized strategy for you and what works for you in your situation. And that'll be yours in your situation, not Bob's next door. Okay. 5 rules of IBC I want to go over, and then we'll get into a couple examples here. First one, take the long view. This is not a get rich quick ploy. This is not a shortcut to get you anywhere per se. It is a long play. It's a life insurance policy. And I'll show you how that works in a minute. But it's interesting. Real estate investors, we are a conundrum because we want to buy rental properties for the most part. Most of us are in the, we want to get into passive income. And so we start accumulating rentals in some form or another. And we're doing that. Why? Because we have the long play. We're thinking long range, and we want to start now and build up passive income over time. But then, on the other hand, we are some of the most impatient people I know. We want that deal done now, fast, yesterday, man, get it done, and so we're impatient, but we're really patient when it comes to we have this kind of worldview where we can kind of see both. We have the need to be rushed, and then we can also be very patient and have the long play, build up enough properties to have enough passive income to actually stop working. And so anyway, that's what this is about. Also, don't be afraid to capitalize, meaning once you see it, you can't unsee it. You will see the effect of compound growth. And almost everyone, once the light bulb comes on, once they see it, and especially on their own policies, all of a sudden the question is not how much do I have to put in, it's how much can I put in. Okay, so don't be afraid to capitalize. Don't steal the peas. This is a reference which is from the book, which you should buy and read again, which I'll put a link to at the end again. Don't steal the peas. Basically, it's an analogy of be an honest banker. When you borrow against yourself, don't steal from yourself. Don't steal from the bank. You wouldn't steal from an outside bank, so don't steal from yourself. So pay yourself back. When you borrow, pay yourself back. Have a means of paying yourself back. Have a plan, at least someday. So that's what that means. Don't do business with banks. Be your own bank and rethink your thinking. I say it time and time and time and time again. Change the way you think about your finances and you will change your life. And I promise. All right. So again, this is a crash course. We're not going to get into the nuts and bolts of policy breakdowns and stuff. I want to show you one case study. If everyone's still interested, I got one more I can show after that, and go from there. So this is a client of mine. And when we built this out, I called him afterwards after we issued his policies and got it in play. And I was like, man, it's a really great example of how to utilize this. And so anyway, I got his permission to use this. Just getting rid of his name off of it. But it's a great approach. So in this guy's situation, he already had some rental properties. He had a day job. He had rental properties. He didn't need the rental property income right now. He was just stockpiling it. And as he would build up enough, he would buy another rental. So he would save up enough to buy a rental and then go buy another one. He happened to live in small town, Midwest. So he was in a little college. He is in a little college town, and he can get properties pretty cheap out there. So he's getting over 50,000 a pop out there, and then he can turn around and rent them, And so I think he's up to like 18 properties now, 18 properties out there. So anyway, what you see on the screen here is an illustration if you've never seen one. Lots of pieces to it. We're not going to kind of break it down. I don't want to get too caught up in this, but I do want to point out a couple of things. So the red box, the left number, the 36,000, you can see if you follow that column down, let me see if I can doodle on this. If you follow that column down, you'll see premiums. He's going to go 36,000 a year for 10 years, and then he's going to drop. We're going to reduce his premiums the next 10 years. Why? Because by the second 10 years, we've created so much compound growth that he doesn't need to keep funding it so much. He's also getting a little bit older. He wants to start ratcheting down his expenses, and see how it plays out. Now, again, take a 0 off if this number is intimidating to you. Add a 0 if this number is chump change to you. Principally, it works the same. Okay. On average, the way we structure these policies, somewhere between, I'm going to just put it here, somewhere between years 2 and 4, the cash value begins growing more than the premiums you're paying in. On average, the way we structure these, somewhere between years 7 to 10, there's a lot of variables. The cumulative cash value will exceed the cumulative outlay. So on the screen here, you can see he's got 368 in cash value, but he's only paid 360 in premiums total throughout his whole life, throughout the past 10 years. But he's utilizing this along the way. This isn't just sitting here, doing nothing, because we need money to move, right? So this money is building up, and I'll show you on the next screen how he chose to apply it. All right. So in his case, we built out this big spreadsheet, and he wanted to see where all the dollars were. So the first thing I want to point out, let's see what I got here. First thing I want to point out is the cash value. Okay, if you look at this column here, this is his premiums that you just saw on that other page. Okay, and then if he front loaded this day one, and you can do it monthly, you build up to 36 throughout the year, whatever, 3,000 a month, and build up. If he front loaded this day one, day two, he's got 22 accessible, okay, in his case. So he's not going to do anything with it the first year. Often people will just, if you're in the short-term business, flips, wholesales, etc., you can pull this money right back out and start using it, and then pay yourself back. Okay, but he's going to build it up. So the second year, he's going to pay a second year in premiums, and he'll have 56K total in cash value. So what he's going to do is borrow. This is the loan column that's going to show his loans he's going to take. So he's going to take a $50,000 loan against his policy and buy a property. Now he's the bank. He didn't finance it anywhere else. He paid cash for the property from his policy. However, over here on the right, he's going to set himself up with a 20-year loan at 4%, which is $303 a month. Okay. So he said, I'm going to make this rental pay back the principal $50,000 loan at 4% over a 20-year period, figured out the amortization schedule. It's $303 a month. Okay. And rents will pay that, obviously. And so that's what he's going to do. So that's why this is his repayment column over here. And this is his loan column. Okay. Now that I've completely scribbled over this whole page. $50,000 loan, buys the property, amortized loan for 20 years. He's off to the races. Now the second year, he's into the third year. He's not going to do anything. But by the fourth year, he's going to take another loan. Okay. Why isn't he doing anything this year? You can see over here the cash value growth as he's paying premiums back is building up a little bit more. But then he funds it another year. And by funding it another year, you see this cash value jump. Okay, does that make sense? Cash value jumped because he did a lump sum. Anyway, so by year 4, down here, he took another $50,000 loan, set himself up with a second 20-year term, 4% on that second property. So that's why you see his payments jump double. So 2 properties are paying 303 a month now. But interestingly, with his policy now, there's enough growth momentum happening. Now it's growing more than he's paying in. So he can actually do it again the very next year. He doesn't have to skip a year this time. He'll take 50,000 out, buy another property. This is year 5. Year 6, he can do it again. Year 7, he can do it again. Year 8, he can do it again. So each year, you see him take 50,000 out. You see his payments jump by 303 a month because each house is paying its own mortgage back over 20 years. Okay, a lot of numbers, but hopefully you can see kind of what's happening here. Now he's fast forward, we're 10 years in. This top line, he's bought 8 properties so far out of that 10 years. And he's up to 2,700 a month between all 8 properties. And then we wanted to see what would happen if we just stopped, if we stopped buying properties and just now we'll just start building it. He could get, this is year 11 for him. Here's the years, 11 years in. He could choose to keep doing it. And he might, like once he sees the benefit of it. Who knows what housing prices are going to be 11 years from now. But so he could still do it. But we wanted to see what it looked like if we stop buying and start accumulating cash value. So again, remember over here, each payment he makes, the cash value is increasing. Each annual payment he makes, the cash value jumps, which the arrow is covering this one. But so you just see this cash value continue to increase over the coming years. The second thing, remember, in his case, we were funding it high for the first 10 years, that 36,000, but then we said we've got enough growth going. Let's slow it down and let's reduce premiums. So that's why you see by year 11, he's down to 12,000 a year. So everybody's situation is different. You know, if you got someone in their 20s, early 30s, we might see what it looks like to go 20 years paying higher if they can, you know, and if it makes sense to, because you have longer, you have longer time in front of you to keep paying. He was 48 when he started it. And so anyway, so here is 17 years in down here at the bottom. He's amassed 561,000 in cash value. He's paying 12,000 a year in premiums. Well, I want you to look at something, what's going on here. He paid 12,000 in premiums over this 1 year, and his cash value grew 36,000 because this compounding effect. So we kind of, you know, kid with him, Steve, would you pay 12,000 to make 36,000? But yeah, I mean, all day long we do. Matter of fact, our next question is, yeah, if that's the case, how much more can I get in here? Once we understand it, you're like, well, if 12,000 will make 36,000, what if I kept paying that 36,000 originally? You know, what does that look like? And so that's the power of compounding over time. But not only that, in his case, look at this. Because he was also making those loan repayments back, his available cash value that 1 year didn't just grow the 36,000, it grew 36,000 plus the loan repayment amounts that year. So he has an additional 52,000 in cash value available that year, having just paid the 12,000 in premiums plus the monthly loan repayments back. So point being, because you're constantly paying yourself back the principal amounts, you're constantly recapturing the original amounts. So you've got that to utilize, plus you've got the cash value increase year over year throughout the life of the policy. So doing 2 things at once, plus you've got the rental income that you've been accumulating. 20 years in for him, 662,000 in cash value. Still just 12,000 in premiums. And I know by this time he's 67. His cash value is jumping about, let's go back here. If it grew 36,000, it grew 52,000 that year. So I know he can supplement retirement at this age by a minimum of 50,000 a year tax-free, because the growth will be growing so much that it won't ever catch up. Like he won't overextend at about 50,000 a year. And it's income tax free. Why? Because he's taking it as a loan, and the IRS does not tax on loans. Yeah, question.
Yeah, I'm sure you explained it, but what is the difference between the gross cash value and the net cash value?
Net net cash flow. Where do you see net? Oh, net cash value is gross cash value is if there were no loans out. On the left side, so here on the left side, 662 is his gross cash value, as if he didn't have any loans, but because he still has this outstanding loan he's paying down, this 524 is building up. It's catching up with the gross. So this is if there were no loans, and this is factoring in the loan, how much is left. Does that make sense?
Yes, thank you.
Yeah, because if he had paid back all the principal loan, over here the net cash value would be equal to the gross cash value, because there would be no loans out. Any other questions on this one? Okay.
No,
Yeah, you got a
I don't
question?
think so.
Yeah, go ahead and unmute, or you feel free to type in the chat if you got one.
Can you hear me?
Yeah, I got you.
So basically, so if I'm understanding properly, you buy a property, a house, and you got a loan from your policy, and how often can you do that in a year?
You can do it
If you have,
you can do it every single day if you want, as long as there's cash value in there to borrow against.
I see.
You know, so this right today he's got 524,000. He could come in over 5 months and take 100,000 out each month if he needed to.
I see.
For something else.
And basically, this is not taxable. Basically, if I buy a house, then instead of owing, let's say, a hard money lender or something like that, and owing to myself or
That's
the
right.
policy,
That's
and
right.
that is completely tax-free.
That's right.
Okay.
So, and I'll explain here in a minute. I'll show you kind of what's going on behind the scenes on you when I'm using the terminology borrow against your policy. I'll explain that here in a minute too. And why I'm using 4% as an example here. So, food for thought, and I always like to point this out. I love this quote I heard once, because when we hear something new, something non-traditional, uncommon, we tend to go, I mean, me too, we tend to go, this can't be right, this can't be true, this is too good to be true, right? Usually if it's too good to be, sounds too good to be true, it is, that kind of thing. But we often hinder ourselves from making different choices because we don't like change. And so that's why I love this quote. I saw it once not too long ago, and he says people change in 4 different seasons. He said when they hurt enough that they have to, and when they see enough that they're inspired to, or when they learn enough that they want to, or when they receive enough that they're able to. Anyway, it's just a great ponderment. It's like, what causes us to change the way we think about our finances? And I always tell people, I heard this once too, we always say we're going to get around to it. We'll get around to it. We'll get around to it. We'll get around to it. When it comes to these policies, I kid you not, people all the time will be like, gosh, I wish I would have started one of these 5 years ago. True. All the time I hear it. And there's no better time than the present because you're going to say it in 5 years. You're going to say, gosh, I wish I would have started this 5 years ago. And we'll say, yeah, but you know when the second best time to start it is? You know when the second best time to plant a tree is? Now. That's right. That's right. So change the way you think about your finances, and it'll change your life, and I guarantee it. I'm going to throw my contact information up here real quick for you, but you know, there's only a couple of you on. We can go further. I can show you a debt recapturing strategy if you want to see more, or we can call it a night and get on a call another time. It's up to you guys. I got a little bit more time left on my end. So what do you say? Keep on going, or you guys want to call it a night? Thumbs up for keep on going.
I would like to see more, please.
Okay, we got it. We got 100% vote. Good deal. This is a debt recapturing strategy. And this is what this will bring together what I said earlier about just changing the flow of the money. Forget how much extra money someone would need to come up with. We accomplished this one by using all existing money. We did it with the previous one, but in a little bit different format. Anyway, client of mine, $109,000 in bad debt when we first sat down day one. He was on a 30-year plan to pay it off. We needed to change the flow of the money and figure it out. So we did, and he will be debt-free in 9 years and have $95,000 in cash value to show for it. Now, conventional financial wisdom says, if we have tons of debt like this, pay it down, get to zero, and then save and get to 95,000. Okay, traditional financial approach. We think linear like this. In a policy, when done right, you can actually be paying, let me do it here, pay down debt and build up cash value at the same time. So that's what's going to go on here, and I'll show you. Again, another spreadsheet. I like spreadsheets. So this was a breakdown of all of his debt. Credit cards, lines of credit, credit card, school loan. Okay. He was dropping $2,079 a month in debt payments. Okay, it was just killing him. Like he could pay it, but it was going to take him 30 years at the rate he was going. So we needed to just figure out a different way. Interestingly, he also had like 25K in savings. It was like an emergency fund. It was just sitting there. He knew it wasn't going to do a whole lot of good just to take that 25K and knock down his debt 25,000, since he had so much of it. It would just swallow up that 25K, and then he understood lost opportunity cost. There wouldn't be opportunity for anything in the immediate future to use it to make money. It would be gone. It would be swallowed up by the debt repayment. So that's why he still had it in savings at the time. So we looked at some numbers, and we talked. I said, hey, what would it look like if we used some of that? If we took 20,000 of that savings and we just kickstarted a policy year one just to get us started and fund the first year, what would that do for us? And so we built this out, and after looking at it, it was a no-brainer. So in his case, we put 20,000 into a policy day one. Day two, effectively, we borrowed about 11,000 of it back out over here, you see on the left. And we wiped out this very first debt. He was still paying monthly. We went after this one first because this was his highest monthly payment, and we needed to free up money pretty quick. So now, because
when did you loan it?
Say that again.
When did you do the loan?
Effectively right after it was funded.
Okay, so
once he dumped 20 in, as soon as the cash value was available, a day or two later, a couple days later, we put in a loan request and pulled it right back out. So
okay.
When we started this, I showed it for 3 months just in case we didn't want to pull it out right away, just to show on paper like what it would look like, So anyway, we took the loan and knocked out the rest of this debt, by month 5, and got it down to 0. And then these are his monthly payments on all the other debts. So through the first year, he's still going to keep paying the regular monthly payments on the remaining debt. But he has freed up $1,287 a month now. So we took that $1,287 a month. I didn't depict it on the spreadsheet. and we start putting it in a savings account. And that $12.87 a month is how we funded future premiums in future years. Because it's easy to figure out how to pay the first year in premiums for most people. The real question is, how do we keep funding a policy? Can we make it affordable? So that's exactly what we did with him. We took existing money he was already spending on bad debt. Once we freed it up, we start putting it over here in a savings account. So that by the beginning of the second year, he had enough and he funded the policy. He dumped all that into his policy. And now he had 14 available the second year. So we took that 14 and we wiped out the next 2 debts. Okay.
Were you making payments on the loan at all?
On the policy loan?
Yeah.
Not yet. Not yet. Because it's unstructured and he gets to dictate the loan terms. We ran the numbers and it made more sense just to wait. Let's wait. And I'll show you how it plays out down here. So now that we paid off the 3 debts, remember the first one, still over here, going into savings throughout the year, so that by year 3, he's got cash value again. But now, okay, backing up, by the time we wiped out these 2, I'm going to erase this. We are introducing what's called snowballing. If you've ever listened to some, financial debt payment guys, they usually talk about snowballing. What snowballing is, if you don't know, is we just freed up 161 a month and 73 a month. So we're going to add that to the next payment, to the 101 a month. So those 3 numbers together equal 335 a month. So we're snowballing the payments so we can increase the payments on the next debt. So that's why his monthly payment went from 101 to 335 here. Again, he's over here saving, funds the next year, has enough to wipe out the next 2 debts. And then we snowball again and do it. This is the beginning of year 4. He's over here funding the policy and then borrowing from the policy and wiping out the next debt. We're snowballing these payments. That's where we get the $792 a month now on the final debt. By the beginning of year 5, he did it again, borrowed against the policy, paid off that final debt. So beginning of year 5, he is completely out, let's call it outside debt free. That's tied to his credit. So he now has no outside debt. But let's be fair. He was paying $792 a month on this last payment, just as a side note. But let's be fair. We've been borrowing from the cash value and accumulating a policy loan along the way over those 5 years. So now he has a $65,000 policy loan. In his case, it's at 5%. But he takes that same $792 a month that he was paying on that last debt and starts
so his original credit card debt was 109.
Yes.
So he's already saved some money.
That's right.
If he's completely out of credit, so the credit card debt is all gone and this is the only debt?
That's correct.
Okay.
That's correct. And not only that, he's still over here putting that $12.87 a month aside so that each year he can keep funding premiums. However, just like the first example, remember in the first example, we did 10 years and then reduced premiums. In his case, we're only going to do 5 years and then reduce premiums. So we dropped, and it's alluded to over here, we dropped part of the premiums. That saved him $959 a month. So now we snowballed. We added the $959 to the $792. That's where $1,751 came from. So that's why our policy loan payments jumped from $792 to $1,751. So let me back that up and explain that one more time. We've reduced premiums, but instead of just taking that savings now in premiums and spending it, we've snowballed. We've said this is money we're already spending. every month, let's snowball that payment again and knock down this policy loan even more, even faster. So now he's paying $1,751 a month on his policy loan. You can see, let me erase his cash value is still increasing each year. One, because of premiums, two, because of policy loan repayments. So 7 years in, for example, he's down to 36,000 in debt and has 45,000 in cash value built up so far. He can utilize this for something else, real estate, whatever. But let me take this to its end. By the beginning of year 9, he will have completely paid off that policy loan and have built up $96,000 in cash value. So we went from 30 years to 9 years debt free, in and out of the policy. We built up cash value, got that debt taken care of. He's got his private family banking system started. Plus, we haven't even talked about the death benefit component, plus living benefits, which are attached to these policies. And now he has funds. He's got $100,000 to do real estate, but he could have started before that. As soon as he started building cash value, he can use it for whatever he wants. Okay. And it's just an amazing approach. Now, this is what I talked about. I want to clarify. I'm using the terminology borrow against. So I want to explain what's going on behind the scenes. Use insurance carrier and private family bank as your cash value. Okay, so you call the carrier, you're like, how much cash value do I have? They look at your policy, you have X amount. You say, great, give me a loan for X amount. So what they're going to do is loan you their pile of money, all the while your pile of money will sit and grow uninterrupted. Okay, now they're going to charge you an interest rate. The product right now this year, the fixed rate is 4%, meaning for the whole rest of your life that you have this policy, you can always borrow against the policy at 4%. Now, during COVID, it was a shoulder shrug. Nobody cared because they could get 0% loans and you can't beat 0. 4% now, everybody's like, oh, this is awesome. I'm borrowing from my policy now instead because I can't get a loan for 4% anymore. So everyone's borrowing from their own bank now. However, a lot of us get hung up on the fact that, oh, well, it looks like we're paying interest on our own money. Like we pumped all this money in there and I got to pay interest now on my own money. But don't forget, you're going to pay 4% on the loan amount, all the while your policy is compounding, okay, untouched. And they have a guaranteed gross growth rate on this same one of 3% plus dividends. Okay, so think back. The first example, the guy that paid $12,000 and the cash value grew 36,000. It grew way more than that 4% loan was costing him. Okay, so that 4%, even if you did it dollar for dollar and no dividends, it grew at 3, it cost you 4, that's a net 1. You know. Furthermore, you are the bank now. If you loan your real estate investment business the money, so on paper, your real estate investment company just took a loan, just like it would hard money and private money, and you're charging yourself an interest rate of 4%. So now that business is now going to write off that 4% because it's a cost in the business. And so now you've just written off that interest that it just cost you to borrow. You with me? Yeah, go ahead.
Wait a minute. Does he have a question?
Yep.
Yeah, so let's say, okay, let me structure that pretty nice. Let's say I make a year, I don't know, $50,000, and that is like net that I save up, right?
Okay.
Now I put the $50,000 into a policy, and I can loan, for example, let's say my business. I do have a HVAC company. I can loan the HVAC business at 4%. I don't know, the $50,000,
Yeah.
and then the business pays me back the money plus the interest rate, and it's been accumulating little bit to little bit. compounding over there.
Yeah, it'll pay back whatever loan terms you've given it. So if you say you're going to pay me back, you're loaning your business. So you're saying HVAC business, pay me back the 50,000 plus 4% over a 12-month period, whatever, because that's what's going to cost you. And now the business is then going to write off that 4%. Okay. Now talk to your accountant. Technically speaking, you just made 4% personally from the business. So talk to your accountant how to play that out, but still, it's still a write-off for the business. So you can save that 4%.
I see.
Okay.
Thank you.
Just depends on, there's too many variables, right? How's your business structure? Do you pay more taxes for yourself or your business and blah, blah, blah. So that's
Probably myself, because the business is an LLC and a tax as a S corp.
Yep. But is your business an LLC? Is it a single member LLC?
No,
It's an S corp. You're an S corp. So is the business a corporation?
it is a LLC, but taxable
Taxes
as an
as-
S corp.
Yeah.
Yeah.
Just depends on how the LLC is structured and how your taxes get filed, in the end. I mean, for you, I understand. You just got to talk to your accountants in the end and say, is it cheaper for me to charge interest to my business and then write off the interest and me pay on the gains? Or is it
What about if it is for a real estate company?
same?
Same thing.
Yeah.
And
Some guys, just like you treat it just like private money. Basically, you're a private money lender to your own real estate investment business. So you kind of have two companies going on. You have your real estate investment business, and then you've got your private money lending business. So you're going to loan your real estate investment business the money, charge it whatever interest you want, because it's going to write off that interest. But the gains go back to you, your private money lending business, as gains. But then you're going to write off the four. You know what I mean? You just
if I put it, what if I put into the policy?
Well, you can't. So you cannot write off the cost of your policy. It's not a tax. Well, you cannot if you write off the cost of premiums. Is that what you're asking? If you write off,
no, it's like if the business borrows money from the policy itself.
It doesn't matter. If you own the policy, it has to go to you, and then you can put that money wherever you want.
I see.
Like you have to call the carrier. The business can't call the carrier and take a loan. Like you own the policy, so you got to call the carrier and take the loan. But on paper, it doesn't matter. On paper, you're taking a loan one way or another. The business is taking a loan from somebody, so it doesn't matter who's taking it from.
I see.
But
what I'm trying to
aside from being able to write off the 4%, the bigger picture is the compounding. The guy that again, I'll use the same example. The paid $12,000 in premiums, but it grew $36,000. That $24,000 gain, not taxable, but that's $24,000 extra dollars that he can use to make money with. That's the bigger picture.
So if I pay myself interest to the policy, that one is a write-off. But if a business pay to the policy, that is a expense, I guess.
So a couple things. This 4% here is paid to the insurance carrier. They take that 4%, it's theirs because they loaned you the money. They're charging you. Okay, but however you structure it, if you say, okay, let me see if I can draw this. You are going to loan your business the money. The business is then going to go make money with it, right? If you're going to charge the business 6%, they're going to write off that 6%. It costs you 4%, so your gain was 2%. Is that even legible? Does that make sense? So
Yeah.
that's why I say, talk to your accountant. Technically speaking, this is a 2% profit for you. You have to sort that out.
Hmm. I
But
see.
but if there's no tax advantage with however your stuff is set up, forget the interest. Or at least charge yourself what it's costing you, and then it balances out. You know,
Okay.
So if you remove yourself as the middleman and the policy is owned by the company, then
Yep.
what?
So the company owns the policy, the company controls the cash value. That's the short of it.
So can the company still write off the
No,
interest?
okay, if you write off the cost of insurance, you will then pay taxes on the gains. So do not write off the cost of insurance, right? Because the IRS says, hey, you're writing off the cost. This is not an investment product. So any gains you make off of it are going to be taxable. So don't. There are not a whole lot of scenarios in small business that make sense for the company to own the policy anyway. If it's a single
So
member
it's not-
LLC, if it's a single member LLC, definitely that doesn't make any sense. You just need to own the policy, and you can loan to your.
So it's smarter, yeah, it's smarter to keep yourself as the middleman.
Say again.
I said, so it's smarter to keep yourself as the middleman.
It is, but it's also, you know, the old acronym KISS, KISS, keep it simple, stupid, you know, and that's kind of like, do we complicate it? You give yourself more paperwork for no real reason if you have a single member LLC and that single member LLC owns the policy, just for the sake of the business to own the policy. Now,
I'm asking because my sister has a policy. That's why I'm trying to learn this. There's policy. We have policies, and I'm trying to figure out how to use them to our advantage.
yep.
And my sister owns 3 bars. So she does have employees and technically like key man,
Oh yeah.
right?
Yep.
So in that situation,
Yeah. So that's a deeper discussion. So we would want to look at
that's when it could become better to have the.
Yeah, in that case, the
company
company should own the,
to
you know,
remove your.
yeah,
Okay.
yeah. If the company is going to get key man coverage, like these banks, this bank example I gave, you know, if
Or maybe do
getting
both.
coverage on managers and owners and what have you, you can even be a type of life insurance retirement plan. You know, it could be a form of retention for management. You know, hey, if you will pay these premiums on the policies, I'm going to get a policy on you, and if you stay for 20 years, we'll guarantee we'll give you X amount a year at retirement, and you're going to borrow it from the policy and you're going to be the beneficiary of the company, because the company knows it will recoup all of that cost in the end. And that's kind of that's a you know, kind of level 301. And kind of, I show you some examples on that. But yeah, there's a lot of situations where, in your examples you gave with the bars, each is its own entity and each would have its own key employees, management, whatever, and certainly its own, you know, the owners, and so it could buy policies on X amount of people who have insurable interest, and then that company, that bar, would control the cash value. You know,
But still don't write it off.
what's that?
But still don't write it off.
Correct. Because of the gains, once you hit the gains, you don't want to be taxed on that. But you get all the benefit of. Let me pull. So I go way back
The
here.
money that the policy made.
Yeah. Let's see if I can get back to an illustration. And
That doesn't go to the employee.
no, he's the life that's insured. Okay, here. Let's just use this one as an example. The employee would be the one insured. The company can decide. The company can say, we're going to insure you. The employee doesn't even need to know how much. He needs to go through the med exam and get approved. You're going to insure this life, and then it's up to you. I mean, you see everything under the sun. You see scenarios where we're going to guarantee you, let us insure you. We're going to utilize the cash value now, however we want. But by the time you hit retirement, we do the math. Like this guy's example. Hey, if you stay with us 20 years, we will guarantee we'll pay you $30,000 a year in retirement. You're going to get that 30,000 from the cash value, because even if you forked out 600,000 and he passes away, you're going to recoup 1.3 million.
So you're offering them a retirement pension out of the cash value in the policy?
You see colleges, universities do it. You see basketball coaches. You hear about it with basketball coaches. They're the ones that end up on the news. Yeah, they do it. We do it all the time. But you don't have to, right? It's just a neat way to encourage employee retention. One, you can. There's a nonprofit, Olivia, who could not be on the call tonight. She used to be a chair on a nonprofit, and they insured her life as a key man policy while she was working for them. She has since left and been gone a few years, but they keep the policy. They have no obligation to shut it down. The contract with her was not such. It wasn't tied to the retirement. Not that she got gypped, but that's just what they can do. And she agreed to it, and it was fine. So they're just going to utilize it however they want. And she's the life insured, but she's gone. She's been gone for a long time, But that nonprofit will continue to reap the benefits of the cash value throughout its life, and someday the death benefit.
Okay, so what, all right, so if you don't think that you're gonna keep the company long-term, like, let's say we wanna sell in like 5 years, is it worth doing it still? And then what happens to the policies at that point if you absolve the company?
So you can have a carryover, change ownership of the policy, meaning you would want the life insured to carry it. Like you could say, the company is no longer going to be around, so we're going to give ownership to the insured. So say the insured is the current owner, your sister, and you're only going to do it for 5 years, whatever. We'll go over here, 5 years, but you haven't really created a ton of growth momentum in 5 years, so you want to keep it going, but we could reduce premiums by the time they take ownership so that they can afford to keep it. If they couldn't afford the 36, we reduce premiums down to the base premium of 12,000 on this example. And then they could take ownership of it there and carry it forward, and they just get to retain whatever's here. The company would want to zero out its loan balance, though, before handing it over.
Okay, so what benefit is there to the company insuring my sister instead of my sister insuring my sister?
Really, it's just a structural thing. So I'll give you a personal example. I have a couple of companies. I have one policy. I have personal policies that I own, but I have a company-owned policy. I actually have moved it over to me this year. But I started that company-owned policy by my corporation because we bought a bunch of real estate. And I wanted the company to have me insured because of all of the outstanding loans we had on mortgages and stuff. And so I wanted that death benefit to go to the company in the event of my passing. But it was cleaner in that instance because it was a corporation, not an LLC. It was cleaner for taxes too, for the corporation to take its profits and pay the premiums, and then divvy out loans. So I had 2 other real estate businesses under that corporation, and so the corporation would loan to the other businesses. So on paper, it's clean, you know, it's a business loaning business. So it made more sense for me to have a business owned policy. I've since shut the 2 real estate down, and it's all been absorbed back up to the corporation. So I went ahead and took ownership of the policy now, because the corporation doesn't need to own it anymore. But I set it up for 2 purposes. Yes, I have access to the cash value now, but the way I'm funding it, that one policy will be my retirement account. And that was its primary function. So I'll keep that, and it will fund me. It will pay my retirement.
The one that's held by the corporation.
The one that, yes, used to be owned by the corporation. The corporation has since handed ownership of it to me personally. So the corporation I now own it instead of the corporation, but the corporation pays me an income, which I then pay premiums with.
Okay.
That's the same. There's just a lot of ways you can slice it. That's why it's really about, you know, and early on I say it's so situational. And so we really would want to dig into how is it set up? What are our real objectives with it? And then we can conclude what makes the most sense. Who should own it? Who should control the cash value? Who's the life insured? And that all comes just through discussion and strategy planning. Okay.
Yeah, that was helpful. Thank you.
Yep. All right, guys. Well, I appreciate you staying with me. I'm gonna throw my stuff back up here. I'm sure you registered, and we will have your information anyway. You'll probably get an email from us in the next day or 2, just with our contact info. And if you want to set up a time to chat more, education is key. I don't charge people for education. We don't charge people for strategy planning. The only money out of pocket is whatever you would put into premiums. Okay. So don't not call us because you're afraid you're gonna have to pay for something. We would love to help you. The only thing we ask, you know, since I don't charge for all this, we say, if I come up with a good strategy for you, use me. Don't take that information and go to your friend agent down the street, right?
Yeah, or word of mouth. Yeah, to refer.
What's that?
I said, yeah, or refer.
Yeah.
Thank you though. Thank you for your time.
Yeah.
Yeah, I appreciate it.
Yeah, you bet, guys. Appreciate you coming on tonight, and we will hopefully catch up with you guys soon.
Thank you.
All right,
thank you very much.
All
All
right.
right, have a good night.
Good night.
Bye.
Bye.